Into this, how many investors might be exposed to this risk without realizing it?
Well, right now, Kelly, the higher education constitutes about 7 or 8% of the entire municipal market. So there is a fair amount of bonds out there. And unfortunately, there's an expectation among some investors that the colleges and universities en masse are very safe investments. And some are. But there are others that are going to have real problems in the years ahead.
Yeah, it reminds me of the way that college towns and university towns had been perceived as better ratings because they had the stability, they had the steady employment, they had it through the last recession. Now they're facing a deep recession of their own. Who's hardest hit? Who's most at risk?
Well, I think the winners, you're going to have winners and losers here. And the winners are going to be the schools with a national reputation, which will allow them to draw students from a wider geographic base. And that's particularly true for schools in the Northeast and the Midwest. Those with ample endowments, financial reserves are going to be okay. And if you've got a really ideal physical location, you're probably going to be fine too. But actually, preferably, you need two of those three characteristics to prosper over the course of the next decade or so. The demographics are actually working against small liberal arts colleges who, from 1996 to, say, 2016 or 17, had the advantage of the baby boom shadow coming through.
Right.
Where you had so many more students coming in and applying to college.
How many of those small liberal arts colleges might have to close? Or to put it in kind of terms for your investors, how many might not be able to service their debt?
Well, right now there are about 1,400 four-year colleges out there in America. And there's probably another 2,000 or 3,000 that are offering community colleges, two-year degrees, et cetera. Among those small 1,400 schools, we haven't picked an actual number, but there's a couple of hundred out there that are just basically suffering from this twin whammy, if you will, of unfavorable demographics and an embedded cost structure, whether it be capital infrastructure that you mentioned before that they've put in over the course of the last 20 years that they're still supporting, or you've got tenured faculty that effectively constitutes an embedded cost. So what we're recommending is that for investors who are moderately conservative, you really want to stick with flagship campuses of big public universities or highly selective private colleges that are likely to ride out the pandemic and the aftermath of that.
Yeah, still, that's pretty stark that a couple hundred colleges could have trouble paying these bills. There's another category that you also warn investors about as being pretty risky, and it's those bonds that are secured by narrow revenue pledges like privatized student housing. Can you explain that?
Yeah, absolutely. And I should qualify the couple hundred. You know, there will be a couple hundred, as you say, colleges that are going to have trouble. It doesn't mean they're all going to default, and that's an important concept. We have to make sure that we tell people. It's not like you're going to see 200 roll over, but there will be a few that will, and you will have a couple hundred that are going through some very difficult times. In terms of those with limited security pledges, the ones that are really at risk right now are those auxiliary revenue bonds that are backed by things like student fees, or intercollegiate sports revenue derived from arenas, things like that. And one other sector that's really having some problems in the last 6 months, our privatized student housing sector.